down payments have always been important. But in the current market, where interest rates remain high and volatile and home values high and relatively stable, boosting the amount you put down can make the difference between a home that's affordable and one that's not. A Zillow analysis of 50 major US metros shows more than twice as many markets become affordable to the middle-income household with 20% down instead of 10. And when I say affordable, I mean the mortgage plus property taxes and insurance take up no more than a third of income. That saves enough of a budget buffer for the household to handle emergencies and other important things. To access some US neighborhoods, households will have to stretch beyond affordability. If you have no other debt, you can still qualify for a conforming loan up to using 43% of income. With only 10% down, middle incomes can qualify in metros like DC, Raleigh, Dallas, and maybe Milwaukee, again with no other debt. With 20% down, the middle income household can qualify in more metros like Charlotte, Austin, Nashville, Tampa, and Salt Lake City. In these areas and nationally, we are over the cusp into unaffordability at the classic 20% down. But we're not stuck there. With home prices more or less stable, mortgage rates don't have to come down too far, just to 6.4%, but that's not something to plan on. Inflation is sticky and the Fed might not drop their policy rate until next year. In the meantime, to get affordable payments for a middle income household, you need around 28% down. Live in a more expensive market where home values have long outpaced income, and you need an even bigger share on top of an even bigger price tag. Take, for example, Seattle. It would take 55% down to bring the monthly payment low enough for the middle income household to afford it. In LA, where the median income is lower and the home price higher, it's almost impossible with 75% down. And that's heavy. That's why so many of us, half of first-time buyers, according to Zillow surveys, need a gift from family or a partnership with friends to become homeowners. Or you have to house hack after the fact. 2 in 5 plan on renting out a home after buying their home. Without a gift from mom and dad, a stock market windfall, or a boost from down payment assistance, which is more generous in expensive areas too, so be sure to check out that section on Zillow pages, it would take a long time for the middle income household to save up for that kind of down payment. Assuming the middle income Seattleite saved an aggressive 10% of their income and put it away every month into, say, a cash account with a 4% guaranteed return, they'd still need to be saving for 22 years to build up that 55% down. In LA, it would take 35 years to get to that 35 for the middle income household to afford a monthly payment. Austin and Dallas, you still need a decade. That ideal home ownership situation is now only really possible for middle income households in the central and Midwestern US, and hence why they remain pretty hot. Home buying aspirations are pretty powerful no matter where you are. And as you can tell, housing is super local. Work with an agent and a loan officer to scope out your options for your income and credit situation for the homes in your area. And good luck out there.